Good evening, everyone. I'm Laurent Deville, Professor of Finance at EDHEC Business School, and tonight I will be hosting this episode of the EDHEC Business School Future of Finance Speaker Series with Professor René Stulz from the Fisher College of Business at the Ohio State University. So before we start, as French people, it seems that we have until the end of the month to send our best wishes for the new year. So I would like to wish you all an amazing year 2026, and also would like to send my thanks to Emmanuel Jerzenko, who created this series of talks and secured the lineup we have this year. I don't think there is much need to introduce Professor René Stulz, who has a long and highly successful career in financial research. So I'm not going to talk about all the papers he has been writing over the years, the honor he has been receiving, the responsibilities he has held, maybe just mentioning that you served as editor of the Journal of Finance for multiple years, as well as co-editor of the Journal of Financial Economics. But if we go all these things, I think we would spend the next hours just enumerating those publications and honors. And so I would prefer that we spend time discussing the listing gap that we are going to talk about today. So, well, I will simply say that you have been extremely influential in multiple and diverse areas of finance. And what you're going to talk about today, the listing gap that seems to be currently be widening in the US, and which may or may not, we will see today, have an importance for the way companies grows and contribute to society. So René, after your talk, we'll have the chance to start discussion with Professor Enrique Schrott from EDHEC Business School and one of our amazing students, Asad Hussein from the MSc in Corporate Finance and Banking. Thank you all you three to be here today with us. And without further ado, René, the floor is yours for the next 30 to 35 minutes. Thank you very much.
Thank you, Laurent. Good evening to everybody. I will talk about the listing gap, and I'm going to explain very shortly what that means. I'm going to start talking about two papers, one that introduced the listing gap, which was published in 2016 with a sample that ended in 2012. This year we last year we updated the results up to 2024. And so I will talk about the update as well. So in my presentation, I will talk about the evolution of public listings in the US and abroad. I will talk about what exactly the listing gap is in the US and how we can measure it. And then I will talk about where it comes from and whether it matters, but we'll talk more about that in the question and answer period. So to get us going, here we have the number of listings. So a listing is, for a stock, is when it gets traded on a public exchange. In the US, in addition, you have to be registered with the SEC. And so you can see the red is the number of listings in the US. And it increased until 1996 and has been falling since then. 2021 was the big exception in this, with a large number of IPOs on firms going public. But the number has kept falling again since then. And then the blue line here is the market cap of the US. And as you can see, that market cap has increased extremely, pretty dramatically, exceeding 60 trillion. But you can also see that the market cap is fairly volatile over time, and can, at periods of time where it really didn't increase in the 2000s. So when we look at the number of listings, we see decrease. When we look at the market cap, we see a dramatic increase. And so some people say, well, I mean, the market is doing well, so why worry about the number of listings? And we will talk about that. Here we have the number of listed firms in the US and elsewhere. And you can see that the non-US developed countries, the brown line, kind of peaks around 2006 and has been decreasing since, but not at a dramatic rate, except after COVID, where the decrease has been faster. If you look at the world has pretty much kept increasing. The number of listings has kept increasing, but at a very slow pace in the 2000s compared to the 20 years before. I looked at France, and one thing I discovered when I tried to look at France, it's actually difficult to get the numbers after 2018, but I use the number from the World Development Indices from the World Bank. And if you use those numbers, France peaks around 2000. It has 724 listings in 1975, 1,108.
Good evening, everyone. I'm Laurent Deville, Professor of Finance at EDHEC Business School, and tonight I will be hosting this episode of the EDHEC Business School Future of Finance Speaker Series with Professor René Stulz from the Fisher College of Business at the Ohio State University. So before we start, as French people, it seems that we have until the end of the month to send our best wishes for the new year. So I would like to wish you all an amazing year 2026, and also would like to send my thanks to Emmanuel Jorzenko, who created this series of talks and secured the lineup we have this year. I don't think there is much need to introduce Professor René Stulz, who has a long and highly successful career in financial research. So I'm not going to talk about all the papers he has been writing over the years, the honors he has been receiving, the responsibilities he has held, maybe just mentioning that you served as editor of the Journal of Finance for multiple years, as well as co-editor of the Journal of Financial Economics. But if we go all these things, I think we would spend the next hours just enumerating those publications and honors. And so I would prefer that we spend time discussing the listing gap that we are going to talk about today. So, well, I will simply say that you have been extremely influential in multiple and diverse areas of finance. And what you are going to talk about today, the listing gap that seems to be currently be widening in the US, and which may or may not, we will see today, have an importance for the way companies grows and contribute to society. So René, after your talk, we'll have the chance to start discussion with Professor Enrique Schrott from EDHEC Business School and one of our amazing students, Asad Hussein from the MSc in Corporate Finance and Banking. Thank you all you three to be here today with us. And without further ado, René, the floor is yours for the next 30 to 35 minutes. Thank you very much.
Thank you, Laurent. Good evening to everybody. I will talk about the listing gap, and I'm going to explain very shortly what that means. I'm going to start talking about two papers, one that introduced the listing gap, which was published in 2016 with a sample that ended in 2012. And this year we last year we updated the results up to 2024. And so I will talk about the update as well. So in my presentation, I will talk about the evolution of public listings in the US and abroad. I will talk about what exactly the listing gap is in the US and how we can measure it. And then I will talk about where it comes from and whether it matters, but we'll talk more about that in the question and answer period. So to get us going, here we have the number of listings. So a listing is, for a stock, is when it gets traded on a public exchange. In the US, in addition, you have to be registered with the SEC. And so you can see the red is the number of listings in the US. and it increased until 1996 and has been falling since then. 2021 was a big exception in this, with a large number of IPOs on firms going public. But the number has kept falling again since then. And then the blue line here is the market cap of the US. And as you can see, that market cap has increased extremely, pretty dramatically, exceeding 60 trillion. But you can also see that the market cap is fairly volatile over time, and can at periods of time where it really didn't increase in the 2000s. So when we look at the number of listings, we see decrease. When we look at the market cap, we see a dramatic increase. And so some people say, well, I mean, the market is doing well, so why worry about the number of listings? And we will talk about that. Here we have the number of listed firms in the US and elsewhere. And you can see that the non-US developed countries, the brown line, kind of peaks around 2006 and has been decreasing since, but not at a dramatic rate, except after COVID, where the decrease has been faster. If you look at the world has pretty much kept increasing. The number of listings has kept increasing, but at a very slow pace in the 2000s compared to the 20 years before. I looked at France, and one thing I discovered when I tried to look at France, it's actually difficult to get the numbers after 2018, but I used the number from the World Development Indices from the World Bank. And if you use those numbers, France peaks around 2000. It has 724 listings in 1975, 1,185 in 2000. And by 2018, it's down to 457. So France actually has a pattern that looks like the US, but with the caveat that we kind of struggle with the numbers for France. But so you could look at listings in a different way, which is economies keep increasing, countries keep becoming more populated. And so you could choose to look at the number of listings per capita. And there the story is even more dramatic for the US. Now in 1975, the number of listings per capita in the US was 22. In 2023, it's 13. The rest of the world has a different story. And the non-US developed countries have a different story, where in 1975, it's about 24 listings per capita, like the US. But in 2023, it's 28. Now, so the US goes in the opposite direction from the rest of the world if you look at per capita data. So the bottom line, population increase, so that listings per capita have fallen more in the US. I'm not going to repeat the numbers that I just gave you. So another way to look at this is to look at the propensity to list. Now, given a number of firms in a country, how likely is it that they are listed? So if you look at the US, almost all firms are private, and it's always been that way. Okay, the US has about 6 million firms, and by that would mean corporations. 21,000 have more than 500 employees. But what has happened is that the propensity of firms to list has fallen. So how likely it is for a firm to be listed, that likelihood has fallen. Okay, and so if you look at firms with 20 employees or more, the likelihood that such a firm is listed is half what it was 50 years ago. So pretty dramatic evolution. If you look at firms with 1,000 employees or more, the likelihood is 50% no. It was 80% 50 years ago. So corporations are less likely to be public no than at almost any time of the last 50 years in the US. And here is a graph that shows the various size categories. The black line on top is for firms with more than 1,000 employees. The next line is for 500 to 999, and you can see the decrease. But no, in all categories, there has been a decrease. So the question is, well, I mean, does the US have abnormally few listed firms compared to other developed countries? And one way to get an answer to that question is to compare listings per capita for the US to other countries that have similar economic development and institutions. So the way we did that in the first paper is to use our regressions of listings per capita on a measure of economic development, GDP per capita, and a measure of shareholder protection, shareholder rights protection, which is called the anti-self-dealing index. Now, it's an index that measures how easy it is for insiders to take advantage of minority shareholders or non-inside shareholders. And we find that the index, a higher value of the index means that shareholder rights are better protected. And we find that the number of listings is positively related to both variables. And in the more recent paper, we extend the regression and the results are similar. Now, so the way we do this is we regress listings per capita. We have cross-sectional regressions, and we have time series regressions. The only thing I want to show is that the better protected the shareholders, the more listings, the greater economic development, more listings. Okay? And then we use that regression to measure what we call the listing gap, which is the difference between the number of listings you would expect the US to have, given this regression, minus the number of listings per capita the US has. And so what we are doing is we are using economic development and we are using shareholder protection to estimate what we would expect the number of listings to be in the US, given the way that the listings across the world relate to economic development and shareholder protection. And when we do that, we end up with this. Now the black is a listing gap. There really wasn't a listing gap in the 90s. It started now in 1999 and increased steadily. And 2023 is its highest value. So what we have here is a number of missing firms in the US. Now, so if the US had listings per capita similar to what the number of listings per capita is in other countries that have similar economic development and protection of shareholders, the US would have more than 7,000 more listings. Now, so if you think of the number of listings in the US, it's about 4,000. It would have 11,000. At the peak in 1996, the number of listings was 7,500. And so we are missing quite a number of listings. So the question is, well, is there something unique about the US? Or is it that the US is ahead of other countries in the decrease in the number of listings? Now, and so understanding why there is a listing gap in the US should help answer that question. So that's what we are going to turn to now. Okay, we saw that there is a listing gap. We saw that the number of listings in the US has fallen pretty dramatically. Now we turn to some possible explanations. Obviously, I could spend hours on those explanations. I will try to give you kind of a summary of what people have been talking about. Now, to understand the listing gap, it's useful to think of how do listings change? How does the number of listings change? Well, firms can come to the market and can list. Those are new lists. And some firms can drop out, and those are delists. Okay, the new lists are mostly IPOs. The delists can occur for really three reasons on an exchange. If two firms in an exchange merge, then you have one less firm that is listed. Now, so mergers are going to decrease the number of listings. Then some firms can be kicked out of the exchange, because they perform so poorly that they don't meet the requirement to be listed. And then some firms may decide that it's not worth it to be listed, and so decide to delist. Okay, and so let's look at the evolution of new lists and delists in the US. So here we have the new list rate in red. It's a rate because I take the number of new lists and divide by the existing number of listings. And the blue is the delist rate. And you can see the story of the listing gap in part here. Now, which is that the US had a high rate of IPO, averaging more than 10% until the end of the 1990s. And then that rate dropped dramatically to less than 5% in the 2000s. And then now there is this spectacular exception of 2021, but the US then immediately went back to kind of what it was before. Okay, and so if you look at that, for the number of firms on exchanges to increase, you need the red line to be above the blue line. Before 2000, the red line is almost always above the blue line. After 2000, the red line is almost always below the blue line. No, so before 2000, or before 1996, the number of listed firms increases. Afterwards, it decreases. And you can see that the delist rate is especially high around the turn of the 2000s, but stays high subsequently. Let's now look at the delistings. The red is mergers, the blue is delist for cause, and the purple dots are voluntary delists. Well, when you look at that, voluntary delists are a non-story. No, they don't matter. The mergers are the biggest source of delistings. And the US had an enormous merger wave in the 1990s, and has had a lower rate of merger in the 2000s, but still a lot of mergers. The listings for cause were relatively low in the 2000s, so it's not a story either. The listings for cause were really high around the late 1990s, and so they play a role then. So how did we get to where we are from the peak? We have a drop in new lists, drop in IPOs. The delist rate stays high. And so we had more delists than new lists. The mergers are the biggest contributor to that high delist rate. And we saw voluntary delists going private transactions are really not important to the story. So let's now turn to kind of the possible explanations. And I will look at three types of explanations. The first one has to do with firms. And whether now if firms change, then being on an exchange may become less attractive or more attractive. And firms have changed. Now, if you compare the firms in the 2000s to the firms in now the second half of the last century, intangible assets have become more important. Now, so when you think of the capital of a firm, now it has tangible assets, it has machines, it has plants, and so on, and it has intangible assets. Now, an example of that would be patents, but it's much broader than that, and we'll talk about it in a minute. Okay, and intangible assets are very different from tangible assets. When you fund tangible assets, you have a collateral. Now, the tangible asset is a collateral. When you fund intangible assets, often there is no collateral. No, in the sense that, I mean, you could be funding research, but you don't know what will happen to that research. You could be funding the training of employees, and that's valuable for the firm, but the employees could leave. No, so you really don't own that the output. You share it with the employees. No, and so tangible assets are very different from intangible assets. Funding tangible assets in that sense is less risky because you actually get to see what you fund, and now it's something that you can hold on to. So now building intangible assets might be easier for firms that are private. Now, if you think of funding a research program, it's very difficult what's going on. Okay, when you look at your professors and they tell you they are doing research, pretty hard to know whether they are making progress and how it's going and so on. It's a lot worse for a corporation. Now, you might hire a lot of researchers and not really finding it very difficult to know what's going on. So investment in intangible assets is much harder to monitor. There are more important information asymmetries. There are more important agency costs. No, I mean, they could be saying we are funding research, but they are funding vacations for a bunch of people. Okay, and so in that case, now being a private company means that you have very concentrated ownership, and ownership that can be very well informed, can be specialized, and can find it much easier to monitor and control agency costs. They have more incentives because they have large stakes, but they also have the ability to acquire information that you wouldn't be able to acquire in a public company. Now, if you're in a private company and you are one of 3 or 4 large investors in that company, you get all the information that you want. So now intangible capital in that sense is something that at least at early stages is better done in private markets. And now there are 2 types of intangible capital that are worth knowing about. One is called knowledge capital. The other one is organization capital. Now, knowledge capital is what results from R&D. And generally, it's going to be patentable. Organization capital is all the spending that the firm does to acquire kind of unique advantages in how it's organized and how it works and how it develops products and so on. So it involves spending on corporate culture, on organization practices, on advertising, on customer capital, on IT, on human capital. So it's important to keep those two types of capital in mind. Together, they form intangible assets. And in the US, over the last 50 years, the intangible asset has become more and more important, as the graph on the right shows. Now it computes intangible assets over total net assets. The problem with intangible asset is that it's hard to measure because the accountants don't take intangible assets into account, mostly. No, in Europe, with IFRS, they do take into account some knowledge capital, but not all of it, not the organization capital. So the two types of intangibles have very different properties. I talked about knowledge capital can be patented. But also, now with knowledge capital, you end up with some kind of product that you can define. If it's a new medication, now you can have it exploited and developed by another firm for compensation. Organization capital cannot generally be patented. Part of it is firm-specific human capital. Now, and the firm's human capital can walk out of the door. As a result, organization capital is fragile, especially for young firms. Now, if you're a startup and you see the startup is not doing well, now you might be tempted to find some other startup that has more promise. And then part of the part of the organization capital leaves the firm. With established firms, it's different. Now, with established firms, much of what you do is standardized and codified. And so it's easier, it's harder for it to walk out of the door. It's less fragile. To show the importance of those two types of intangibles, how their importance differs across industries. On the left, we have healthcare. Okay, and organization capital has been low and fairly stable for healthcare. Knowledge capital has become more and more important and is a big component. Now, so if you look at the typical biotech, which would be under healthcare, it has almost no tangible assets. It has an enormous amount of knowledge capital, and it has some organization capital. On the right, you have the business services sector. That's a very large sector in modern economies. Some of the largest companies in the world are part of that sector. And it's all about organization capital. Knowledge capital is very little. So kind of the composition of intangibles varies a lot across sectors. Now let's turn to the growth of private markets. Now it has become much easier to raise capital without being public because of the growth of private markets. There's been a dramatic growth in private equity. Deregulation in the US helped that. There was a big legislation in 1996 that made it a lot easier to raise capital privately. And now even private equity claims have become more liquid. There is a secondary market for that. So the liquidity advantage of being public has fallen. So if you look at all that, it's a lot easier to stay private now than it used to be because there's more funding available. At the same time, now there are kind of two problems with this. First, the fact that you can get the funding doesn't mean that you are better off being private. Now the question for a company is how can it create the most wealth? And that's not necessarily in the public market, not necessarily in the private market, but it differs across companies. it differs across stage of the life cycle for companies. A big issue with the private markets is now you can't really short private firms. Okay, I'm sure you have seen in your courses that the ability to short shares, to short stock, is hugely important in making the market efficient. Okay, and so as a result, now the pricing in public markets is expected to be much better than the pricing in private markets. Now, if you can't short in a market, the most optimistic people will drive the price, and that may be a price that is too high. So there is an efficiency question that we'll get back to that is important. Here you have a plot of the increase in global private capital raised. And you can see that it has increased pretty dramatically. And except now in recent years, it has fallen some. But obviously, this increase has made it easier for companies to stay private when those companies thought that that was the best route for them to create value. In the US, there has been a huge amount of talk about the regulation of corporations. And now the topic I'm talking about has gotten a lot of attention. Now the graph of the number of listings that I showed you at the beginning was used by Jamie Dimon in an annual report of Chase, JP Morgan. And so it's something that people have talked about a lot. At one point, so much talk about regulation. If you follow kind of the regulatory debates in the US, the new head of the SEC, Atkins, is talking about making IPOs great again. And he thinks that by changing regulation, he can wipe out the listing gap. No, and he has used that kind of language. The problem with that is, in the US, the number of listings started falling before regulatory changes. And the regulatory changes did little for the smallest firms because they were exempted. So it's hard to argue that it has much to do with regulatory changes. At least from my perspective, I find it hard to believe that the changes were important. What is right, though, is the whole regulatory apparatus is not designed for a world where the firms have few tangible assets and lots of intangible assets. Now, that's true in the US, and that's true in Europe as well. And that's a problem if you want to be public. Now, if you want to be public, then you have to satisfy the accounting regulations. And those don't do a good job with intangible assets, which makes it a lot harder to communicate the value of the intangible assets that you have. So should we be concerned? I could have a number of slides on that. I mean, one factor or one issue that seems important is that we live in a market economy. In a market economy, you want the prices to direct economic activity. And so you want the allocation of resources to be efficient. But for that to happen, prices must be visible and efficient. They are for public markets. Now they're visible and relatively efficient on average. In private markets, they are not as visible, and they clearly are not as efficient. So there's a question as to whether there is a resource allocation cost. by having more firms in private markets. Not enough research has been done on that. But there is kind of one dimension that I think is instructive about that issue. Now, since we are in Paris, we can talk about Philippe Aghion. And now it talks a lot about creative destruction. And in my recent research, I show that whether firms are listed or not plays an important role in creative destruction. Now, as the number of firms that are listed increases in an industry, you end up getting more creative destruction subsequently in that industry. But now the issue of how to assess the listing gap is made complicated by the fact that for some firms, they clearly are better off being in private markets. And we have more of those firms. Now, as we talked about, young firms building intangible assets are generally better off doing it in private markets. So listings in the US peak in 1996. They peak later in developed countries. In the US, a huge listing gap emerges. The gap is a result of low IPO activity and high merger activity in terms of accounting. The low propensity to list can be explained, at least in part, by changes in firms on private markets. I think I'm ending just in time.
That was perfect, René. Thank you very much. Before I leave the floor to Assad and Enrique, I would just ask a question slightly related to this kind of question of growth and finance. So there has been this question about, is the size of financial services the right size, and at some point, do they benefit growth or not? And my question is that, does this listing gap result in the financial industry being different, being larger than expected, smaller than expected, or smaller than would be good for society? Do you have any insight with respect to that question that may interest our students as well, since they want to place themselves in the financial industry at some point?
Okay. So I would think, I would say that the main impact is that it changes the composition of the industry on what the industry does. And in some sense, we are going back to the world of the late 1800, early 1900. Now, at that time, you had firms, financial firms, that played an enormous role in reorganizing industry and in helping young firms to get started and to grow and so on. Now, JP Morgan at the time did that. And those firms did that by both providing debt, but also investing equity of their own and being on boards. And so they were very active in supporting firms. And that went away with the Great Depression in the US, when firms had to choose between being banks or being investment banks. And so JP Morgan ended up being a bank, and then Morgan Stanley was the investment banking piece that separated. We are kind of going back to a world where we have institutions that performed the roles that JP Morgan did in 1900. And now those are kind of the large private equity firms. And those are, have become very large, are controlling an enormous number of private firms and so on. And so you could see, if the world keeps evolving this way, that now the commercial banks will become less important in terms of their role in funding firms, in influencing industries and so on. And more, there will be a bigger role for private equity firms. So that's kind of one change that is taking place. And now we talked about regulations of corporations. Banking regulation obviously has played a big role in this evolution in recent years, in making it harder for banks to even lend money. And so no, that's a contributor to this evolution. No, this all could change. I mean, who knows? Maybe in 2 years we won't have banking regulation at all. But no, things can change.
Okay, thank you. Assad?
Yes, I'll go on. So first of all, thank you very much, Professor, for this presentation. It's very interesting for us, a student who's studying about the financial industry and getting to know about all this problematic, the US having fewer and fewer listed firms, and the debate raising about the efficient capital allocation via private financing. But I'll have 2 main questions. The first will be taking a step back. So we get to know that there is a decline in the number of publicly listed firms in the US, and there is a significant increase in the aggregate market capitalization. If we look at the welfare perspective, like should economists and policymakers care more about the number of public firms or about the size and profitability of public markets? And also, like, what risk or like overlooked if the focus is only on market capitalization?
Yeah, so that's a key question. No, I mean, I think a lot of people have a misunderstanding about the relationship between market cap and growth. Now, the correlation between a country's growth and the growth of the market cap, that correlation tends to be close to 0 or negative. No, it's very low across countries, now cross-sectionally. So now markets that have done very well doesn't mean that the country's economy is doing very well. And now that's some things that people in Paris seem to spend a lot of time studying. Now the issue is the market cap can increase for lots of different reasons. No, I mean, one reason that the market cap of a firm can increase is suddenly it has a very hot product and it has eliminated all the competitors, so is able to charge very high prices. No, and so when you think of that in terms of welfare, it's not obvious that that's really good. And no, so if what's going on is that you have more concentration of companies that are able to charge higher prices, that may be good for the shareholders, but not necessarily for economic growth. Okay, and so question then is, well, what matters for economic growth? Now, what you would like to see is lots of creative destruction. No, you would like to see new firms come in, replace the older ones, have better products, have better ways of doing things, more efficient ways of doing things. That's going to be good for economic growth. That's not necessarily good for the market cap of the firms, no, because there's a lot of competition coming from new firms. But you want an economy where new firms find it easy to find funding, find it easy to be listed, and find it easy to kind of challenge the existing firms. And so, no, I wish that I had a ton of research to point to support my argument, and I don't. No, I mean, so if some of you want to become PhD students, that's a wonderful area to study. But so I would be careful in how to think about market cap versus the role of the stock market on economic growth.
Okay, thank you very much. So yeah, we need to make a clear distinction between these two subjects. Another question that arose during the presentation that we get to know also as a student, like the growing role of private market, the private debt, private financing of firms. And during the last slide of the presentation, it raised concerns about potential misallocation compared to public market. And you talked about creative destruction. I just wanted to know if you could go more deep in it and explain what really happened, like more and more private financing happens, and how does it affect, and how does it create creative destruction for the firms?
So, I mean, I think the ability of startups to get funding in the US is fantastic. Now that contributes to economic growth, and it's something that you would want in other countries. It's something you are starting to get in Europe, and it's good. So you want new firms to be created, and you want it to be easy to create new firms. You want it to be easy for people to get funding. And the private markets are very good at that. At the same time, there's a concern as to whether, in some sense, there isn't too much money going to private markets for reasons that are not necessarily good in terms of economic efficiency. Now, if you're an institutional investor, there is one huge difference between private market investment and public market investment. With public market investment, you know every day what your portfolio is worth. You see it every day and you can follow. If you're in private market, you don't really know. No, I mean, it's going to be very stable over time. The returns are smoothed. It's hard to unsmooth them. But at the end of the day, the value of your investment depends on when the fund you are in can convert the investments into cash. Okay, and so from the perspective of an institutional investor, it's nice because there is little reported volatility. And so your life is much better. Okay, but that's really not something that's helpful in terms of economic growth, in terms of capital allocation. So there are lots of good things about private markets, but there are also things that are problematic. The fact that you can't sell short means that the price signals are not very good. And so that can lead people to overinvest. And it can lead to bubbles and so on.
Okay, thank you. So a last question, going into the same subject. So maybe more like generally, like what would be the optimal framework for private and public firms today?
Well, so no, I mean, in the US, when you look at regulations, and I bet it's the same in Europe, but I don't know as well. Now you would like a level playing field between private and public markets. Right now, it's not a level playing field. No, I mean, if you go in public markets, you are going to be heavily regulated. And you are going to get a lot more attention from politicians. You're not going to get a lot more attention from regulators. So beyond the regulation as they are written, now your life is just much more difficult. And it's especially a problem in the US because in the US, corporate law is at the state level. So if the politicians at the federal level, like Congress, want to affect corporations, Now they have to do it through disclosure laws on that type of laws. And so that leads kind of a situation where public firms are subjected to disclosures that further political objectives, but are very different from the private firms. So, I mean, you would like, at least from my perspective, a world where there's a more level playing field, and there is more transparency on the private side.
Okay, thank you. I think it's all for my question. I'll let Professor Schrodt take the next questions. Thank you again.
Right. Thanks, Assad. Yeah, René, two hopefully quick ones and related to your other work. So my first question is I'm curious, has there been a trend also in the age distribution of firms remaining public? And does that trend follow the gap that you've tracked in this paper? Well, I'll let you answer that one, and then the second one I'll follow after.
Yeah, so I mean, from the start, from the peak in 1996 of the number of listings to today, now you have kind of two big trends in corporations. They get older. Now, so the average age has increased. Not because you don't get young firms coming into the markets. They get older, and they have gotten much bigger. Now in terms of average market cap. And now that's, as we talked about, the ways that you can get fewer public firms is if public firms merge. And we have had a lot of mergers now, and so the firms have become much bigger. And it's a development that is really a development that started in the 90s. And I don't have a plot of average firm size, but it has increased pretty dramatically. Now, one issue that people have talked about is kind of antitrust on merger regulation in the US. Effectively, it disappeared. No, and so you didn't have kind of enforcement of competition laws and so on in the US for a number of years. And that leads to a situation where firms can merge horizontally, which they weren't able to do for a very long period of time before that. Now, an horizontal merger would be one within your industry. And so that has affected size, obviously. Now, you could say there are good reasons for that to take place, and they could lead to economic efficiency. Now, in the sense that IT developments in IT made it possible to manage much larger firms efficiently. But it certainly leads to bigger firms.
If I may rebound on that question, does that has an impact on financial stability to have this kind of old and very large firms? So maybe that could be viewed as positive in the sense that they are stronger, or more risky in the sense that if one fails, it may have critical issues for markets and for probably for portfolios in a sense. So we have seen that with some companies in some countries that are getting extremely large and at some point completely lose the perspective of their market and kind of almost disappeared. So if we think about Kodak, we think about Ericsson, this kind of stuff may happen. And if companies grow too large, would that become an issue for financial stability?
So now there are kind of two ways to look at size. One is to look at the assets, and the other one is to look at the market cap. Now you have firms with large tangible assets that have very little market cap. Now you think of the car industry in the US. there are very large firms in terms of number of employees, in terms of the assets that they have, in terms of tangible asset plans and so on. But their market cap is not that big. And now if those firms kind of stop their business completely, that would have big economic implications because they employ a lot of people. You think of NVIDIA, no, it's the largest firm in terms of market cap, or at least I still think it is, but Google is coming close. But think of NVIDIA, now the market cap is about 4.5 trillion. Think of the tangible assets of NVIDIA. Now some of you may know the number. Think what number would surprise you? Well, the actual number is 6 billion for a 4.5 trillion market cap firm. Okay. But NVIDIA produces nothing in the sense that all the production of the chips are not done by TSMC. And so it's not clear what, I mean, if it collapses, it will be bad for portfolios, but it's not clear to me what kind of the impact would be on the economy. I mean, suppose that we discover tomorrow that there is a new firm that can produce more efficient chips than NVIDIA at half the cost. That would be really bad for NVIDIA, but it would be great for, could be great for society. No, I mean, you want progress to take place.
Okay, thanks a lot. Enrique, you had a...
Yeah, one last one. So in also your prior work, you identified a trend in cash holdings by public firms, and you attributed it mostly to a trend in cash flow volatility, itself explained mostly at the industry level, right? So industry cash flows were more volatile. Is this trend related to listing gap? Could it be something behind it, also complementary to the private market explanation?
So one thing that has become clear is that firms that have a lot of intangible assets, are very intensive in intangible assets, are firms that hold a lot of cash. So there is a very high correlation between the two. And a number of people have worked on that issue. The argument that comes out of that literature is if you're a firm with only intangible assets, you really have no collateral. You need collateral, and the cash is going to be the collateral. Now you need collateral with respect to investors, but also employees. Now, I mean, how would you feel to work for a firm that has no cash, no tangible assets? Now, how do you know how long that firm is going to be around?
Great. Thank you very much, René. I think that was very enlightening talk. And I hope our students see clearly now what's going on and whether this is a good thing or a bad thing, because that is also important, that we see that the world is changing, and sometimes this is in a better way and sometimes in a worse way. So well, would like to express all my thanks from EDHEC Business School to you, Professor Stulz, and as well to Assad and Enrique. Thank you very much for your time and presentation and questions. In 2 weeks' time, we will have another presentation of our speaker series that's going to be by David Raprak on the anatomy of machine learning-based portfolio performance. So quite a different perspective that we're going to have on the next speaker series. That's going to be Tuesday, February the 3rd from 6 p.m. to 7 p.m. Paris time. Thank you all for your engagement and for your contribution to this speaker series. So we're perfectly on time, and for that, I also thank you very much, Professor Stulz. Have a good remainder of the day, and then for the ones in France, good evening to all. Thank you very much.